Investing in rental property can be very lucrative when done properly. However, investors thinking of jumping in and becoming a landlord might be thinking twice, particularly since we're well into the longest bull market in history. It could be detrimental to make a large purchase in such a financial commitment when home values could plunge by nearly 30%, like when they did when the housing market crashed in 2008. If you've been saving up thousands of dollars to invest in real estate, is now a good time to take the plunge and part with that cash? That money could be a large percentage of your net worth, and making a bad purchase could be a major financial setback. If you've been planning to purchase an income-producing property, is it a good idea to buy now? My name is Chris, and I'm here to teach people about money, personal finance, and investing. If you're interested in improving your financial situation, make sure to like this video and subscribe to the channel. Unless home values are artificially inflated as they were leading up to the housing crisis of 2008, we can normally expect values to rise. At the time, banks were making mortgages to people who were not able to repay the loans, forcing up prices. Due to federal deregulation, banks were giving money to nearly anyone because the more loans they were able to originate, the more money the banks made. They were overqualifying underqualified borrowers, often with no proof of income, and when the payments couldn't be made, many homes went into foreclosure, creating a downward spiral in home values. At the same time prices were falling, banks tightened their lending guidelines, making it much more difficult to get a loan to purchase a home. Hopefully, there are lessons learned from this overlending and it won't be repeated. Under normal market conditions, a purchase is relatively safe from an appreciation standpoint, where we can realize a 3% gain in value year after year. Your rate of appreciation will vary based on location, current interest rates, market conditions, and so on. But over the long term, the value of the property is going to increase. Mortgage rates are very low, which is favorable to anyone looking to purchase. In fact, the interest on a mortgage isn't much higher than the average rate of inflation, so borrowing money is relatively inexpensive. Although property values are higher than they've been in the past, the low borrowing cost could keep your mortgage payment lower. The difference in costs on a $250,000 loan at 6% interest and a $250,000 loan at 4% interest is over $300 per month. Those savings can make a big difference when you're analyzing cash flow and the amount of income that a particular property will generate. Consider that home prices could be more favorable to buyers in the future, but when and if that happens, interest rates could be higher. Even though you might be getting a better price on the home, you might not be getting a great price on the loan, which can be equally important. The interest rate on a mortgage won't make a big difference if you're not planning on keeping the property for a long time, but rental properties should be a long-term investment. Many new and seasoned investors are wondering whether to make a purchase when prices are high, and as experts are constantly talking about a recession. Sure, if the market crashes, home prices will decrease, but demand for rentals tends to increase in addition to market rents under such conditions. This is because few people are willing or able to purchase a primary home. Banks are more stringent during times of uncertainty, making it more difficult to qualify for a mortgage. Jobs are less certain as business slows down, and income tends to decrease. Also, many people are afraid to purchase when prices drop in the same way investors get out of the stock market when things head south. But those that are invested through all economic cycles make the most money in the long run. If your goal is to hold on to the property for many years, a temporarily reduced home value won't be a big deal, especially as you enjoy your continuous cash flow during all market cycles. Waiting for the dream deal or golden opportunity can easily cause you to miss the good deal, the one that will make money. If the fundamentals of rental income, operating expenses, and demand are strong, it may be time to stop looking for the perfect deal. Often people step over dollars to pick up dimes, searching for the ideal property. Learn to have realistic expectations about returns and accept that once due diligence is exercised and the deal you're considering passes the analysis, it might just be time to pull the trigger. There's risk associated with every investment, so if the numbers make sense and you have your ducks in a row, buy the deal. Remember, your first deal doesn't have to be a home run. Otherwise, you'd be kicking yourself a few years down the road when someone else is enjoying appreciation, cash flow, mortgage paydown, and tax write-offs. Like investing in the stock market, it's unreasonable to wait to buy a stock that's going to appreciate tenfold. When you're just getting started, a 10% return is sufficient. What's most important is getting in the market, because the earlier you start investing, the quicker your money will compound. Anyone considering investing should save up at least 6 months of reserves and keep it liquid at all times. This means 6 months of mortgage payments, taxes, insurance, and every single operating expense if the property were to sit vacant. That way, if you do experience a prolonged vacancy or encounter a major expense, you'll have the parachute to protect yourself. It's likely that the bank will also require you to have this amount of reserves. Estimating the amount needed to purchase your first property is difficult. Between a 20% down payment, closing costs, reserves, and funds to improve the property if repairs and updates are needed, and extra money to pay the bills until the property is fully occupied, ends up being much more than the 20% down payment initially anticipated. Most banks require at least 20% down for investment properties, which is much higher than a primary residence because investment properties are riskier to lend on. If you lost your job and had to choose between your home and a rental property, it's obvious which one would get paid for. Secondly, the bank wants a cushion if they ever need to foreclose and assume the property. If they needed to take the property due to default, they would face large expenses such as holding costs, possible tenant eviction costs, real estate agent commissions, and other possible losses depending on the condition of the property. The extra cushion is beneficial to the investor as well. Even if prices drop the day after you make a purchase, you'll still have that extra buffer before you're upside down, meaning that you owe more on the property than it's worth. While the future real estate market is uncertain, the tax benefits are realized immediately. There are many tax advantages when owning property because the government encourages people to provide housing and they receive revenue from property taxes. These deductions include mortgage interest, property depreciation, repairs and maintenance, home office expense if you use space at home to manage the property, and insurance. All of these deductions will most likely leave you having to pay little or no tax on the money the property generates, which is one reason why real estate can be such a fantastic investment. When you renovate your property to increase its value, all of those expenses are tax deductible. This is especially desirable for those in high-income tax brackets, where deductions make a large difference in their tax bill. The mortgage interest, which is already a great deal with current rates just above inflation, also reduces your tax liability. Just compare that to your IRA distributions, which are taxed at ordinary income rates. Even though it's a substantial investment, can't be sold immediately, and requires monthly payments, a rental property is a very stable asset. Investors and homeowners can't sell their property immediately when there's bad news headlines, which adds to the long-term stability. This is the opposite of the stock market, where investors sell everything in panic when there's bad news, causing the market to drop dramatically. While you might be nervous that property is somewhat difficult to sell in a hurry, remember that it's also a good thing that prevents sudden, severe price fluctuations. There's a reason banks are willing to lend 80% of the purchase price. Just imagine what a bank would say if you asked them to lend 80% of the purchase price for stocks, gold, and bonds. Banks know their business, and they're very cautious when lending money, and they know which investments are stable. There will always be some landlords that regret purchasing a property, as they tell you about the nightmare tenants who damaged the property after being evicted, and phone calls for clogged toilets during the middle of the night. We hear similar horror stories about people who invest in stocks and lose all of their money, claiming they'll never do that again. The truth is, landlords who have a high level of professionalism and treat their rental properties as a business are almost always satisfied. By doing proper research on the topic of landlording and carefully analyzing deals to determine what's actually going to make money, and not purchasing simply because they think it's a good investment, you're setting yourself up for success. Not over-leveraging and having realistic expectations in regards to effort, returns, and potential downsides, you're prepared to buy a profitable, long-term investment that can provide unparalleled returns. Never mind the other benefits received from this type of asset. There could be a downturn in the future, but it's also possible that prices could steadily rise and never drop. When following the proper steps, the odds of making money are in your favor, and remember that every type of investment involves risk. This risk can be mitigated by following the proper steps.